First time home buyers. Right now may be one of the most opportune times for first time home buyers that we've had in the last decade. Not only is affordability much better, interest rates have also dropped, and now your purchase value, your purchase power is going to be much stronger. I'm Bwanka with the Compass team.
And it's Safras with the Compass team.
And today we're talking to first time home buyers, and we want to let you know all the different programs that are out there that are going to make it much easier for you to be able to get your foot in the door, get into the market, and get that first property. So Safras, I know you know a lot about these programs. How many programs are there for the first time home buyers?
Depending on what you're looking for, there's about max around 8 you could take advantage. There's definitely more, but those are very niche case scenarios, like renovations, making a second suite, but we're not talking about that today. But we'll talk about the top 7 or 8 today.
Okay, and out of these 7 or 8, what would you say is your favorite one?
The favorite one, I would say for me, is the newer program that they made recently. So in the past, we'll talk about the next program again, which is similar to this, but this one is my favorite. It's the first time homebuyer savings plan, right? So the way RSPs work is slightly different. It's similar to an RSP. So what you could do is you could put up to $8,000 every year into the savings account. The advantage of putting it in there is you get a tax rebate. So, we're talking from top down. Let's say you make $100,000. As an example, you put $8,000 in that year. So for that $8,000, you get a tax rebate. So if you're in a higher income bracket, from depositing that $8,000, you might get a tax break of sometimes maybe $4,000, $3,000. It's a large amount. And it all is just to use this account. And the reason why I like this account compared to other accounts is you don't have to put that money back after you buy a home. So many of the programs, you have to either give it back, it's a loan, it's a temporary help to get you for. This one, you don't have to worry about that. You get the $8,000 and it's a maximum of $40,000 total. So you could start, when you're younger even, just putting a couple of grand in here and there. And then at the end, when you're buying, you take out the 40 grand.
Okay. I like that one. So that's going to be your favorite one. My favorite one is, it's a little bit different. It's a newer one, and it's going to be the mortgage amortization of up to 30 years. Now, before, it was you could only go up to 25 years. And now it goes up to 30 years. And the difference between 25 to 30 years, it's just going to be your monthly payments are going to be lower. And it is going to take you longer to be able to pay the whole property off. But from our history, what history shows, and from everything that we've seen, the majority of people buy a home every 5 to 7 years. So it's gone are the days where it's 25 years before, like you buy a place and you just stay there for 25 years, you pay off the mortgage. That we don't really see that anymore. I'm sure in other places outside of the GTA and some people who bought 25 years ago are doing that. But the majority of people, especially a first time home buyer who's buying now, you're going to be out of there within 5 to 7 years. So if you can lower that payment and make your life easier for you right now, that's a huge benefit. So that's why my favorite one is going to be the mortgage amortization, which has been extended for 30 years.
Yeah, I think, if you talk like 30 years ago, people were able to buy, their final house that we would call today. It's 3 bedrooms, it has a garage, maybe a pool in the back, all for very, comparatively speaking, it was very affordable, 30, 40, 50 years ago.
It was a lot easier to save up for a down payment for that.
So, what are they going to upgrade to? So they just stayed put. Whereas now, the younger generation, we have to start, maybe with a condo, a townhouse, and slowly grow that. That's where that 5 to 7 year timeline comes into play.
Yeah.
And also if I always say, for me, I always look at it life-wise, projecting my own personal income. It's, as I'm getting a little more mature, it's going to go up. So, if your income increases, instead of spending it on something else, you can just do a little bit of extra monthly payments. But again, the most important thing is you know that for those 30 years, it's like you get the bottom line payment, at least up front.
Yeah.
And if you want to add tack on top, fantastic.
Yeah, no, that's great. Okay, so then what would you say is going to be another one of your favorites?
I think this one is very important. It's the land transfer tax rebate. So in Ontario, you have to pay land transfer tax. Actually, in Toronto, which is the GTA, you have to pay double tax, right? So
but hold on, not GTA, Toronto.
Toronto.
Yeah.
Yes, sorry, you're right.
Yeah.
My fault. So Toronto, sometimes I think Toronto GTA is the same,
Yeah.
but it's definitely not. So in Toronto, you have to pay a municipal Toronto tax, and in Ontario, you have to pay the federal tax, property tax, land transfer tax. So the truth is, it depends on the purchase price of your property, the amount that it will cost. But I know it's a little archaic the way they've done it, but it's based on a much, much lower amount, assuming less than a 500K purchase. However, it exists. Take advantage of it. Why not? Mm-hmm. So if you're buying in Toronto, you get both tax rebates, land transfer tax rebates, that totals to exactly $8,475. If you're buying outside of Toronto, so Durham, Richmond Hill, out west, you'll get $4,000 back. Again, it's better than nothing, right? So you might as well take it.
Yeah, cash is always always better than nothing. So we've talked about the mortgage amortization. We've talked about the land transfer. We've talked about the FHSA.
Yep.
So these are probably going to be our top 3.
Absolutely.
Now let's talk about some other ones and what are some of the benefits of them. So what's another one you really like?
So another one that I like, because I actually used it. I personally have used it, is the RSP, Homebuyers program. So in the past, you could based on your income every year, you get like a percentage of how much you could deposit into your RSP.
Mm-hmm.
Obviously, it's saved for your retirement. However, the government kind of came to realize that a lot of people have that money. They don't want to wait maybe 40 years and they need the money to buy a house. So the government has allowed now, this is newer. Before it was only $35,000. Now it's $60,000 per person that you can take from your RSP. The advantage of that is, again, example, I'm a first-time home buyer and I'm saving my down payment. I'm saving maybe $100K. So if I'm putting every year maybe $5,000 to my RSP, I get a tax break on that. So your $5,000 really becomes, at least in the short term, maybe $6,000, right? So it just helps incrementally. Mm-hmm. But again, take advantage of it.
Yeah. So with the first-time home buyers savings account, that one you don't have to pay it back.
Exactly.
But with the RSPs, you do have to pay it back. So talk to us about what does it look like paying it back? Do you have to pay it back right away? Do you have to pay it back slowly over time? Do you have to pay it back before you retire? What does that look like?
So the way it works is you do get 2 years of grace period. So 2 calendar years of grace period. And after that, you get 15 years to pay it back. So let's say, as an example, you took 50,000. You take that 50,000, split it into 15 pieces, and you pay it back every year. And the advantage of it is also, you have a year where you needed some extra cash. You don't have that extra, couple grand to put back into your RSPs. That's okay. What happens is they just tack that back on to your income. Okay, so basically you're off.
It doesn't always have to be cash out of your pocket.
Exactly.
It can just be, if you made 100,000,
exactly.
Now you gotta put 102,000.
Exactly. And a smart way to do it is, let's say you are like self-employed or you have a commission-based income or like variable income. On the lower years, you might as well put a little bit more in, right? Mm-hmm. Or not, like you could take on more of that income just because it offsets the numbers. So I really like it, and I personally took advantage of it. And again, it's you combine the 40,000 from the savings account plus this, you're at 100K tax free, tax deductible, which is a lot of money if you really look at the numbers.
Yeah, no, and it helps because that's always one of the biggest issues that we see with people is it's very difficult to get your foot into the door, but a lot of the people do have money already invested in saving in that RRSP account.
We have a lot of clients that are very high income earners, can afford a mortgage pre-qualified at X amount, but the hard part is getting that first 100K. I think Warren Buffett said the first 100K is the hardest. So it's the nature of the game in stocks and this. It's the same thing.
Okay, so let's talk about it. The first thing, let's establish what is CMHC insurance.
So CMHC insurance is basically like, it's third party, but it's like a government program that works with any bank that you go with. So typically, like, let's say ourselves, as we own homes. When you go to the bank, you say, hey, we're gonna buy a home. Typically, you're gonna have to put 20% down. right? And quick math: if you're buying $1 million homes, that's $200,000, and we haven't even touched closing costs.
If you're buying a $500,000 house, first-time home buyers, it's $100,000, and it's not easy to get $100,000.
I would tell you, it doesn't matter what your income is, especially in an expensive city like Toronto. It's really hard to save 100, 200 plus closing costs. It's very hard. We totally understand. That's why they've implemented this insurance. So the insurance is basically you put down, let's say 5. If it's a 500K home, it averages out, right? So you could probably get, now up to $1.5 million, which you mentioned earlier, 10% down. So, typically, let's say you're buying a $150,000 home. Example, if you're multiple time home buyer, you need $300,000 plus closing costs. Here, you only need the $150 plus closing costs. So what this does is, CMHC works with whatever lender, bank, mortgage lender that you're working with. So CMHC kind of covers the extra, and then the bank puts the rest. So the bank still puts the 80% or a little bit higher, but CMHC guarantees it for them. Yeah. So there's CMHC, there's a couple of programs, Genworth. The advantage of this is, again, ease of entry into the market. That's the whole point of this video and what the government is trying to do.
Yeah.
Ease of entry.
Even a lot of times what people say to me is, well, I'd rather put down 20% because then my interest rate is going to be lower. But the thing is, it actually doesn't work like that. The banks, they actually prefer that you have that CMHC insurance because now the mortgage is insured. They have insurance on it. Whereas 20%, they don't have any insurance on it. So once they know that it's insured, it makes it actually easier for the banks to give you a lower interest rate. And now you're paying even less and putting down even less, which makes your life a whole lot easier, especially as a first-time home buyer.
Exactly. And, the good thing about having the CMHC, especially now with the 30-year amortization, and you'll get a better rate. And sometimes the rate difference between putting 20% down and getting the CMHC, it could easily be like 0.3 to 0.5%. And if you look at the 5 years, let's say you have a 5-year term and you look at that, many a times you'll save on interest. That's big. When you do the calculations, sometimes I did a calculation recently for a client. It was about 20 grand over just 5 or 6 years. And I'm like, yeah, you do have to take part of this program, of course. But you get to keep the extra cash that you have, maybe the extra 10%, and you get better rates. So, if at the end of the day, you're not buying real estate today and selling tomorrow. Like you said, maybe it's a 7-year hold. Let's look at that 5 to 7 year period. That for me is that's what I do. I look at the 5 to 7 year period because in a year, you're like, I'm shortfall a bit, but it's about getting into the market. That's the most important thing.
Yes. So to dive deeper and help you break it down and understand it a little bit more. So putting down 5% is up to $500,000. So if you're buying anything less than $500,000, you only have to put down 5%. Once you go higher than 500,000, it becomes 10% on whatever's higher than the 500,000. So 0 to 500 at 5%, and then as we go up to, let's say, 750, there's 250,000 here. That 250,000 is at 10%. So 25K plus this is 25K. So if you're buying something for 750,000, you're putting down 50,000 plus the closing costs.
Exactly.
And it just keeps going like that anything over 500 up to the 1.5 million. So say you were getting a $1.5 million place, again, same sort of math, 0 to 500,000, that's going to be 25K. 500,000 to $1 million, that's gonna be at 10%, that's gonna be 100,000. So you're gonna be putting down 125,000, whereas you go a little bit higher, you're gonna be into 20% down, and that does make things a whole lot tougher.
And in the past it was only $1 million. So you'll see a lot of people buy exactly $999, $900.
Yeah, this just changed.
This has just changed very recently in the last 6 to 9 months.
Yeah, this is
very recent.
So
the 1.5 is very recent, as well as the 30-year amortization. Both are very recent. So now we're seeing people who can afford it. Of course, they're stretching their budget now to 1.4999. Right? It's a huge change with just this program.
Yeah, and this is why exactly the way that this video started was this is probably the most opportune time that first-time home buyers have had, because there is all of these incentives that are coming into it. And now let's talk about pre-construction.
Oh yeah.
Because there's a lot of really good incentives with pre-construction right now that we've never seen before. Normally, you do have to put down 20%. Some projects, you can put down less than that. And we are going to see more incentives because pre-construction is very, very slow right now.
Absolutely.
But pre-construction takes 4 or 5 years to get ready. And what we can see is after 2026, 2027, 2028, 2029, there is a huge shortage of new construction properties that are going to be coming to the market. So we are going to see a lot of incentives. I strongly believe in pre-construction and getting something that's going to be ready 4 years, 5 years. I just got one last year. I'm a strong believer. If you don't agree, you can let us know. You can throw it in the comments. But we're here telling you what we think. So now let's talk about kind of what are the rebates, what are the incentives when a first-time home buyer is buying some new construction.
So, when you look at pre-construction, like a price list, someone says, hey, I bought it. When you buy a home, you look at the price. But whenever you buy a resale home, it's like when you buy a product, when you sell it to someone you don't really pay tax on it, right? It's a second-hand product now. Mm-hmm. But when you buy in pre-construction, you're technically buying a brand new build. So what happens is within that $1 million, example, you bought a townhouse or a house for $1 million. I like to use simple numbers. That's why I always go to the million.
Make it easy for you.
Yeah, exactly. So 500 to $1 million, doesn't matter. Within that $1 million, there's a GST / portion of an HST. So the the government actually charges tax within that price. So usually when you look at closing statements on a pre-construction and it's $1 million, you'll actually see, my purchase price was like $950. But the $50K, the government used to pay for it, but the builder got that part. Okay, so now this is the newest program, and this is exciting. Up to $1 million at least, you can buy pre-construction, and the government will give you the GST HST rebate for up to $50,000. Depends on purchase price. So they do the quick math. It's easy. There's so many calculators. Variable purchase price, and you get $50,000 for $1 million. And then it incrementally decreases. The max is 1.5. So maybe I did the math recently for around 1.3, you might get 20K back. But hey, as long as you're getting the good incentives and you're getting this back on closing, like it's free money. You could use it to count towards, your savings, remove your down payment. So if you put up extra down payment or you take advantage of these programs, you put maybe 5 to 10% down, you still get cash back for $50K up to $1 million. But it does go up to 1.5, and if you get closer to 1.5, it's closer to 0, simply put.
Okay, so I think the last one that we have to talk about is the renovation credit. Again, it is very niche. It's not everybody is going to be using it, but who do you think would be using this renovation credit?
So the renovation credit, there's many programs for first-time home buyers. So some, as an example, is if you're a first-time home buyer with the CMHC program, and you have kind of like a basement apartment ready to go, but you want to make it legal. Mm-hmm. You want to expand the windows. There's a few of them. Windows, you get $100 for windows. That's not for first-time home buyers. Specifically for first-time home buyers, it's incentives. Like if you're making like your house or condo energy efficient, you get a rebate. Okay. Right? So all these small programs do add up. It's very niche specific, and we always talk about for first time owners, the difficulty is like the savings part. These programs are more like, I have extra cash. Mm-hmm. You still need the money. Yeah. But like example, like I was looking into it for a client recently. If you're making a basement unit or a secondary suite, the government will loan you $80,000 at 2% interest. That's crazy. $80,000 at 2%, counting inflation, that's free money. That's what the money will cost. So programs like that do exist, but again, I don't really like to talk to it too much because it's very, very, very specific, and you need to already know about it before you kind of get into the weeds for it.
Okay. We talked about so much today. If you have any questions, if anything went over your head, if you want to dive deeper into it and talk to us directly, click the link that's right below. Set up a discovery call, and we'll be able to talk from there. But if you just want to understand a little bit more about what's going on, just throw something in the comments, and we'll get back to you, and we'll be able to talk with you and discuss and kind of help you move forward and understand what it is that you're really getting. But yeah, we've talked about all 8 of them. Is there anything that you want to touch on before we go?
I say if I were to start from, if I was me 10, 15 years ago looking to start, I would definitely, 100%, the first thing I would do is open the FHSA, which is the tax advantage account, number one thing, and then slowly work your way up to the other ones.
Okay. Well, we really do appreciate you being here with us. Share this video with someone, and huge shout outs to you for making it to the end with us, because it shows that you want the knowledge, and when you have the knowledge, it makes the decision so much easier, and you're going to become a real estate investor sooner than you know. But I'm Bwanka with the Compass team.
And it's Safras with the Compass team.
And we'll see you guys on the next one.